So to begin, we have Ms. Tay Yan Ling, Portfolio Manager, Asia Total Returns Equities from GIC, and she'll be sharing with us her personal investment journey from the time that she was a student, just like most of us here today. So let's welcome Ms. Tay. Ms. Tay, please.
Hi, good evening, everyone. Very nice to see all of you today. To give you some background about myself, I've been with GIC for about 4 years, and I'm with the Asian equities team. So together with a team of other 8 people, we invest in equities in Asia, including Japan, Australia, and other emerging markets in Asia. So today I'm here to talk to you about my own journey. So I've been investing on my own since I was year 2 in university. So I think a lot of you probably, I'm not sure if you guys invest on your own or not, but I think for many of you, you are wondering as a student, how should I even start investing given that I don't have probably much capital to start with, nor much knowledge. So before I start, just wondering, when someone say invest, what comes to your mind? Anyone wants to share? No? Okay, I expected that, so it's okay. I will tell you what came to my mind when I was a student. So when I thought investing, I actually thought investing was like gambling. To me, investing was a game of luck. You could either win big or you could lose big. And I had no idea, how to even play this game. So this comic, I think, not sure if you can see it clearly, but so the girl asked the dad, Dad, how exactly does the stock market work? And the dad says, well, you put your money into it, and for some reason you lose money, and then you panic and sell, and someone who's smarter than you wins the money instead. So I thought that, I was not smart enough to do investing. I didn't have any idea how to read those charts. I didn't have idea how to tell, if the stock price is going to go up or go down. I had no knowledge or much knowledge about finance. So, to me, investing was really a black box. What do you think this is? So I thought investing was for old people, people who had money, who wore high-power suits, who were rich and had money to spare. I didn't think that investing was for a poor student like me. So when I was in year 2, investing was really a very far-away concept to me, and I never even thought it was possible. But what really changed my mind was I actually made a few friends, and they were investing on their own. So every day they would be very excited, talking about new stock ideas, talking about how much money they made, and I was very interested in what they were saying, because at that time, as you know, the banks probably are giving low single-digit, low 0.something% interest. So I was thinking, it's such a waste to not use my money for something better. So I decided, okay, I'm going to start investing. So what I did was, I first went to set up a brokerage account. And as you know, there are quite a few different options. So I spent some time comparing and contrasting the brokerage account. And if you want, we can talk more about that later. So anyway, I decided on a brokerage account. So I put some money into it. And then I decided, okay, so now I have to start buying a stock. So at that time, I really had no idea what investing was all about. So I just randomly picked 2 stocks. And as you know, when you invest in Singapore, in the past, each lot was 1,000. So if, let's say, for example, the share price is $1, you have to put minimum $1,000 at that time. Now it has come down to 100. So, I picked 2 stocks. And who would like to guess? How many of you think it went well? Raise out your hand. Okay. No, so I suppose not many people have faith in me, but you are right. So these were the 2 stocks that I bought, First Resources and China Aviation Oil. So First Resources is a palm oil company, and China Aviation Oil is a jet fuel company. So to be honest with you, at that time, I had no idea what these companies were doing, and I had no idea what drove the stock price, what drove the earnings. I just randomly bought them. So you can see the red circle was actually where I bought them and where I sold them, which was actually very stupid, right? Because if you see if I held, it might have done better. But anyway, so at that time, when I bought it, the share price started falling. And I felt terrible every day because I didn't even have any idea why the share price fell. So that was how bad it was, right? So, eventually I decided, okay, I need to start afresh. And I decided to just cut my loss, sold everything, made a loss, and start anew. So what I did this time around was I actually went to read about investing. So the first book I read was Intelligent Investor. How many of you have heard of this book before? Yeah? Okay, very, very good. So it's a book written by Benjamin Graham, who's the teacher of Warren Buffett. And one thing that he said really changed the way I thought about investing and changed the way I actually think about looking for stocks to buy and at what price to buy them at. So what Benjamin Graham actually said was that price is what you pay and value is what you get. So what Benjamin Graham really believed in is that when you invest in a company, you are actually an owner of the company. And every company actually has an intrinsic value of the company. So imagine if you are an owner of the company, you actually get all the cash flows that the company is making, right? So the value of that company should be the present value of all these future cash flows that are coming up. So investing is really about looking for a chance when the companies are trading at a price below their intrinsic value and then buying these shares. Because eventually the stock market, he believes is a weighing machine. So eventually the share price should go up to realize the value. So what I did was I decided to try out his method. So I started building some models for a few companies that I was interested in. I forecasted, and then I forecasted the cash flow, and then I discount it back to come out with an intrinsic value. And then when the shares actually came down below intrinsic value, I decided to buy them. And it actually worked out well. So I thought, oh, okay, this approach actually worked. And then, one fine day, something happened that changed my view. So there's also a phrase called value trap, right? Are you guys familiar with the term value trap? So basically, even though the share might be trading below intrinsic value, there is always a possibility that this value gap may never close. So that's when you actually have a value trap. So what I did at that time was I actually invested in this Indonesian instant noodle company that was listed on Singapore. Now it's been delisted. And it's a very small cap company. So I think if you have been trading in Singapore shares, you are quite aware that sometimes small cap companies' share price is quite erratic. So this company, I did a DCF, or discounted cash flow, and then I found that, okay, it's trading below intrinsic value, so I decided to buy. And then the share price just kept going down and down and down. And I had no idea what was the reason, because there were no bad earnings. It was already very cheap. So I bought more, right? Because that's what you're supposed to do, right? If you really believe in something, you should average down. But it just continued going down. So eventually, this company actually got privatized, and it actually got bought out. But it was bought out at a price that was below the intrinsic value that I calculated, and also below the price at which I bought the share for. So this was my first experience with a value trap. I realized something can be cheap, but it can actually stay cheap. So so at that time, I decided to change my style a little bit. So I continued reading, right, about investing, and I came across this term called quality. So I think you guys have probably heard the term competitive moat or business moat before, right? Yeah. So this is actually many investors actually like this theme, which is basically in a perfectly competitive market, you know that competitors will come in and then your margins will be eroded. So eventually no one will be making any margins. But in some businesses or in some sectors, companies can actually successfully build a moat around their business so that they can always maintain their very good margins, right? So what are some sources of moat, for example? You'll have brands, right? So you can maybe argue that Coca-Cola has quite a strong moat from a brand because people identify with it. It could be scale. Right? So I think all of you use Taobao, for example. So Alibaba has very big scale, and because of the scale, people use the platform, and because people use the platform, merchants actually want to join the platform. So these are just examples of moat. So when you actually look for companies to invest in, you should actually think about looking for companies with moat. But looking for moat is also not easy because moat can be eroded or can disappear. So for example, BlackBerry, right? It's an example of something where the moat has eroded. And even Coca-Cola, you might argue that going forward, can the moat still remain, given that everyone is moving towards health food? So this is something where you have to think yourself and analyze. And when you think about owning a company, I mean, I would want to own a company with a moat. So then the question I had was, how do I go about looking for a company with a moat? So one way is actually really just looking around you, thinking about what brands you like, what are some things you would always buy, what are some places you always frequent, and these could be potential candidates with moat. A second way is actually through equity screening. So if you set up a brokerage, some brokerage account will actually provide you with equity screens. So what you can do is you can list out some matrix. So for example, like I've put the picture on the left, right, and it's an example of a screen. And usually when you think of companies with moat, these companies will meet certain criteria like having margins, maybe gross margins above 50%, operating margins above 30%. If you want to find a company with a strong balance sheet that will not go bankrupt, you want to find something with net debt to equity, which is quite low, or very strong interest coverage. So you can actually list down all these matrix and then use the equity screen, and they will generate a list of companies that meet this screen. And from there, you can actually go about looking for certain suitable companies. So now I actually shifted to quality companies, right? And I wanted to buy quality companies at a discount. But then the problem is quality companies don't come cheap because everyone knows that they are quality companies, right? So they are very expensive. So unless there's a major crisis, like for example, at that time, Berkshire Hathaway, I'm not sure if you guys are familiar, but it's actually a Warren Buffett company. There was news that he had cancer, so the share price actually came down. So I bought into it, and that has been a very, very strong performer. But this sort of thing is very rare. So my style started shifting a little bit to quality at a fair price. So right now, recently, I've started changing my style again to actually trying to catch a little bit of cycle. Because if you can actually catch cyclical turns, you can make quite a lot of money with it. But the problem with this style is that it's a bit more volatile, and you need to do a lot of work in trying to catch the cycle properly. So you might not want to have your entire portfolio doing that also. So you want a balance of it all. So just to end off, in my entire journey, here are some things that I have learned, and which are actually things that I wish someone had told me before I started investing, right? So there's no perfect style. As you go through your own investing journey, I think you will discover what style suits you, and it really depends on whether your personality. Are you the kind who is able to buy when the market is going down, or are you the kind who just freeze and I just can't do anything? Do you have the time to actually go and do the work to look for stocks? If you don't, maybe you want to consider passive investing, which is just buying the index. And you might even want to consider just regularly buying the index because you might not be able to time the market well. You should also think through your financial goals before you start. So think very clearly about what are your retirement goals, what age you want to retire, and then you can calculate how much money you would actually need and what kind of return you would need, right? And some of you might be thinking, why do I even need to invest? Why don't I just put the money in the bank, and let it be safe? But inflation kills, right? So let me just illustrate this with a bowl of mee pok, okay? So when I was a kid, right, which is 1997, I think maybe a lot of you have not been born, but a bowl of mee pok was $1.50. And now, 20 years later, mee pok is $3, right, at least. So if you had put $1.50 in the bank, right, even if you assume it was 1% interest at the time, it will only be $1.83 now, which means that you cannot even buy a mee pok just by saving your money, right? So you need to at least invest that at 3.5% per annum in order to afford the mee pok now. So same thing about retirement, right? So I've done some calculations here, but I won't go into it. But assuming that you want to retire at 60 years old, and assuming that now you are 20 years old, so 40 years from now, you would actually need minimum about $1 million, okay? You can change your own assumptions and things like that. And if you save $1,000 a month in the bank, let's say at 0.5%, you will only get $500,000, which is not enough for your retirement. Okay, so I think this is some food for thought about how much you actually need and how much you need to invest for retirement. Starting young is very important because the power of compounding is immense. So maybe just to show you this chart, right? If you want to get $1 million at retirement, assuming 6% return rate, if you start saving now at 20 years old, you only need to invest $360 a month. But if you wait until you are 40, you need to invest $1,436 a month. So you can see the big difference in terms of that. Lastly, I think it's quite important to be disciplined about portfolio allocation. So you need to know what kind of tools are out there, and then you need to know your risk appetite. So the general rule is that when you are young, you actually have higher ability and higher capacity to take risks. So you should actually tilt your portfolio towards more risky products. But of course, you need to think about your liabilities. Do you need to leave aside some money for emergency? And also think about some of the other tools out there that's available, like the Singapore government saving bonds and things like that, if you want to manage the risk of your portfolio. Also, when you're investing in shares, I would say that as much as it's important to get the core right, it's also important to manage the sizing of each bet. Okay, so that's a risk management. So that's also an important part of investing. Yeah, so I'll just end off here and I'll pass it on to Chris, who will share with you more about the different financial tools out there. Thank you.